Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Roblox's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Roblox is an online game where users interact with each other to explore and develop immersive user-generated 3D experiences. When you sign up for Roblox, a user personalizes their unique Roblox identity, which is known as an avatar. Users can play the game for free, but in order to acquire specific enhancements or avatar items, you need to go to the company's avatar marketplace using the virtual currency known as Robux. In order to get Robux to buy these items, you have to use actual money. Any user can be a developer or creator on the company's platform using Roblox's free studio of software tools. It began to grow rapidly in the second half of the 2010s, and this growth has been accelerated by the COVID-19 pandemic. In the third quarter of 2021, it had 47 million daily active users and 11.2 billion hours were spent playing the game. There are over 40 million games on the Roblox platform, but the company refers to these as experiences, not games. It generates revenue from the sale of its in-game currency, Robux, advertising deals, licensing agreements, and royalties. When people purchase Robux, the company takes 49% of the money earned from that transaction. It splits that percentage three ways towards future R&D, platform hosting support, and operating costs. The other 51% is split between the developer, the App Store, and also payment processing fees. The company is headquartered in San Mateo, California, and was founded in 2004. The stock trades on the New York Stock Exchange and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at $58 a share, and they have 579 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see their free cash flow grows a lot, from 35 million way up to 600 million. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that grows 5 times, from 325 million to 1.7 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain the website is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit, and that grew about 5 times, from 252 million to 1.2 billion. Below that is their operating expenses. Research and development is their biggest operating expense. Also, marketing is part of operating expenses. Below that is their operating income, which is negative every year. And below that is other income and expenses. These are all the gains or losses not part of the company's core operations. And asset impairment is an example of something in this category. Below that is their pre-tax income, then their taxes, then their net income, which is negative every year. This is the company's income statement from their quarterly report. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. Their revenue doubled from 252 million to 509 million. In the first 9 months of 2020, their revenue was 614 million. Just in the third quarter of 2021, it was 509 million. The nice thing about their product is it's easy to scale. You can sell it all over the world at minimal costs. 68% of their revenue comes from the US and Canada, 19% from Europe, 7% from Asia Pacific, and 6% from the rest of the world. I read a majority of children in the US use Roblox. I think it's like 80%. I forget what the age was. I think it's below 16 or below 14. But that's just mind-blowing to think about it. Below revenue is the cost of revenue. These are the expenses directly related to generating the 509 million of revenue. Their gross margin is a whopping 74%. That's gross profit over revenue. The median in the industry is 58%. The average is 43%. Developer fees are 130 million. Infrastructure is $117 million. Research and development is their largest expense at $138 million. General and administrative is $52 million, and $20 million for sales and marketing. All of these numbers include the payroll for the employees that work in these areas. In addition to the employees' regular payroll, there's stock-based compensation, which is a non-cash item. Stock-based compensation brings down your net income because it's an expense, but we add it back on the statement of cash flows because it does not reduce cash for the company. That's a big reason the company has positive operating cash flow and negative net income. They have an operating loss of $77 million, which is worse than last year of $52 million. And their net loss is $77 million. Last year was $50 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generate positive operating cash flow every year, and it's over $700 million in the trailing 12 months. That's more than 7 times as large as 2018. So they're growing at a phenomenal pace. They do invest over $100 million in CapEx. That's investments in property, plant, and equipment. Most of the CapEx investment is their software and software infrastructure. It looks like they don't issue any debt. They're funding their growth on capital stock. They issued $151 million in 2018, $3 million in 2019, $165 million in 2020, and $600 million in the trailing 12 months from the IPO. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. Operating cash flow minus CapEx gives you your free cash flow, and they have lots of free cash flow, nearly $600 million in the trailing 12 months. This is their operating cash flows. This is from their statement of cash flows in their 10Q. This shows us the first 9 months of 2020 and the first 9 months of 2021. And the way to calculate operating cash flow, you start with your net loss. That was $356 million. Then we have to add back the non-cash items on the income statement. $53 million in depreciation and amortization, $221 million of stock-based compensation, and $32 million of non-cash operating leases. But the main reason the company has positive cash flow, over $500 million, and negative net income is because of the $616 million of deferred revenue. Deferred revenue is when people buy gift cards. The company cannot book the revenue until the customer buys merchandise using Robux. It's the same thing as buying a gift card from Starbucks. Starbucks cannot book the revenue until you use the card and buy coffee. Even if you spend thousands of dollars at Starbucks, but all in gift cards, that's not revenue for the company. So in the first 9 months of 2021, $616 million of gift cards were purchased that have not been used. So it's carried on the balance sheet as a liability. But the company does book the cash. The other accounting entry is deferred revenue in the liability section of the balance sheet. When the customer uses their Roblox gift card, they'll pull the deferred revenue off the balance sheet and book the revenue onto the income statement. That's why I always say, look at the cash. That's a much better indicator of how the company's doing. So they're cash flow positive, a very healthy amount of cash flow at that, over $500 million, even though they're reporting an accounting loss. Same thing last year, an accounting loss of $200 million, $345 million of operating cash flow. This is the investing and financing section of the statement of cash flows. In their investing section, they purchased $48 million of property and equipment. It looks like they acquired some companies and spent $46 million. And through those acquisitions, they spent $8 million on intangible assets. So in their investing section, they had a cash outflow of $100 million. Last year was a cash outflow of $5 million. In their financing section, they raised $60 million from issuing common stock and $534 million from issuing preferred stock. Preferred stock is a hybrid between debt and equity. A customer receives a guaranteed interest payment like debt, but they don't get the stock price appreciation like common stock. But they do receive some stock price appreciation. This is for the first 9 months of 2020 and the first 9 months of 2021. This is the equity section on their 9/30 balance sheet. They have $600 million of equity. They raised $1.4 billion from selling their business, and they lost $840 million from running their business. Accumulated deficit is a sum of all their prior net incomes. But even though they have an accounting loss, they're cash flow positive. Let's look at the capital structure. 594 million of equity, 244 million of debt. They're 71% equity, 29% debt. And they could pay off all the debt with the cash on their balance sheet and still have 1.7 billion of cash left over. I gave them the middle whack on Finbox, 6.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past 2024, that's 23 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $20 billion. We divide that by 579 million shares. And we get a calculated stock price of $35. They're trading at $58, so they're trading at a 66% premium. It's a sell according to the model. Their revenue is projected to grow 19.2%, so I grew it 19.2% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by these 4 revenue numbers. And that comes out to 31%, so I multiplied their future revenue estimates by 31%. That's how I got their future free cash flows. Simply, Wall Street is in the other direction as me. Their valuation is $99. They're saying it's 42% undervalued. 10 analysts priced this stock, and the average price target is 117, the lowest 70, the high is 136. The company IPO'd in March 2021. The stock didn't move too much the first 8 months. It went up a little bit, but then it shot up like a rocket ship at the end of 2021. But the market has been detracting, and the stock has crashed the past few months. Since the company IPO, the stock is down 18%, while the S&P is up 16%. The 52-week low is 54, the high is 142. And the stock is trading below its 50-day and 200-day moving average. And this is a really popular stock. Over 20 million shares are traded each day. Of the 579 million shares outstanding, 332 million are on float. When a share is on a float, that means it's available for investors like me and you to purchase. When a share is not on float, that means it's held by an insider and cannot be purchased by the general public. 87% of the shares are held by institutions and over 6% are shorted. Their employee count has been going up the past year. They employ almost 1,000 people. If you invested $10,000 into this company when they IPO'd, your investment would have been close to $18,000 at one point. But if you're still holding on, you'd be at $7,700 today. That's a 23% loss. In the past year, there's been no insider buying, just selling. So you can see lots of people have been selling. And you really can't blame someone for selling stock because some of these people have been working years or decades at this company. And it is possible they made very little money in that time. They want to finally cash in on all their hard work. But of course, you want to see insiders buying, not selling. Institutions own 42% of the stock. Venture capital and private equity is 29%, the general public 15%, and insiders 13%. The biggest shareholder is Altos Ventures at 14%. The founder and CEO owns 9.5% of the company, 55 million shares valued at over $3 billion. When he started the company, for years they kept it small and didn't do any marketing. They wanted to keep it out of the mainstream, but then it just became more and more popular over time. I'm sure he's not complaining today. Then Index Ventures owns 9%, Morgan Stanley, then First Round Capital. Let's look at their financial ratios. Negative PE since they have negative net income. They have a pretty high price to sales of 20, that's stock price over sales per share, and a high price to book of 57, that's stock price over book value per share. Let's look at their non-current assets. 227 million of property and equipment, 220 million of operating leases, 125 million of deferred cost of revenue. They have 118 million of goodwill. Goodwill is the premium you pay when you acquire another company. They also have 63 million of intangible assets. When you see intangible assets, that's probably due to an acquisition or multiple acquisitions. A company can internally generate intangible assets, but that's not too common. And 6 million of other. They can easily cover their current liabilities with their current assets. Their current ratio is 1.3. Quick ratio is also 1.3 since they have no inventory. Let's look at their current assets. Nearly $2 billion of cash, $169 million of accounts receivables. This is how much money other companies owe Roblox. $38 million of prepaid expenses and $380 million of deferred cost of revenue. These are expenses that have been incurred, but the project is not completed. Once they complete the project, then they'll take the expenses off the balance sheet and pass them on to the income statement. Let's look at their current liabilities. $20 million of accounts payable. This is how much money Roblox owes other companies. $158 million of accrued expenses. $118 million of developer liability. This is how much money they owe their developers. And $1.6 billion of deferred revenue. These are gift cards that have been purchased but have not been used. Once the individual uses the gift card, then they'll remove this amount and put it onto the income statement as revenue. If somebody bought me a $100 Roblox gift card, my $100 is in here. Once I use that gift card, they'll remove $100 from their balance sheet and put it onto the income statement as revenue. So that means their revenue should be even higher than it is because of all these unused gift cards on their balance sheet. They generated $600 million of free cash flow in the trailing 12 months. They have $600 million of working capital. So they're well funded. They have nearly $1.2 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 29 companies in the same industry as Roblox, and these are the top 20 by market cap. Roblox spends more than average in CapEx. They have a worse debt to equity ratio. They don't pay a dividend. Their free cash flow is almost double average. They're the fourth largest company on this list in terms of market cap. All their price multiples are much worse than average, although their price to sales is not that much worse than average. Their revenue is almost exactly average. They have a pretty poor ROA and ROE because the numerator of these equations is net income. To summarize, I have them trading at a 66% premium, and maybe my model was a little too aggressive, because as I went through this video, it actually looked like more of a buy than a sell. But the problem is, these companies IPO at such a large market cap, it doesn't give you that much room for growth. Like when I bought Facebook, the market cap was so high, it took years just to make some money on the stock. And Facebook is a Goliath. It's a huge outlier. Not many companies generate as much money and bring in as much revenue as Facebook. I do see lots of potential with this company, but there's so much competition. Sometimes these games seem like fads. You hear about them for a year or two, and then they kind of fizzle out. Then there's a new game that's more popular. That's just something to consider. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.